Hi, my name is Jordan Wilson. Today we're back to take another look at mutual funds. This time, the perceived advantages of using mutual funds to create your own portfolios. This probably will not be a long session, not because there's few advantages in mutual funds. There's actually quite a few. But as you'll see, we've covered many of the advantages in past sessions. This kind of just brings it together, hopefully. Previously, we talked about the vast number of funds that are available for mutual fund investors. Every asset class, every subclass, every strategy, every type of analytics or factors, even access to investments that you might not be able to acquire on your own. If we look at, for example, Fidelity in the United States, you want international growth stocks. They got them. No, you're interested in only US value companies. You want those American dividends. You got it. Took a trip to Tokyo and are quite fascinated with Japanese small cap companies. Fidelity has a fund for that. International real estate, they got it. If you want to get into the more niche areas like water sustainability, Fidelity has a fund. Disruptive automation, another fund. Same on the credit side, the fixed income side. You want Arizona municipal bonds? There's a fund. No, I prefer global credit, higher yield. Yep. Short-term, long-term, mid-term, there's a fund for you. In Canada, a smaller fund community, as we saw in the last episode. But even there, RBC, if I'm a investor that prefers no loads and lower minimum investment values, maybe their Series A mutual funds interest me. RBC offers 286 of those funds. 150 of those are equity, 31 Canadian equity funds. I want small caps. I want dividend income from Canadian companies. I want large caps, value. There's funds. 50 US funds, 31 global, 34 international or emerging markets. So again, just through RBC in Canada, you can build a portfolio in a fair number of configurations. So lots of investment options. The other point I just want to make quickly now, for those that may not know this, is that in general, or as a rule, a global mutual fund or global ETF is one that holds investments from around the world. And that seems fairly obvious. However, an international fund holds investments from around the world except for your home country. If you're a Canadian investor, a global equity fund would hold investments from America, Europe, Asia, etc., plus Canada. An international fund would not hold Canadian equities. Same with the US in reverse. And it's a big issue for Americans because the US equity market is roughly about 45% of the globe. So if I am invested in a global equity fund, probably half of that will be American stocks. And if I'm an American and I already own the S&P 500, the NASDAQ 100, the Dow Jones 30, so on, I may end up with a lot of duplication or overlap in my overall portfolio. So I either want to possibly divest my American-only investments or consider international. As a Canadian with only about 4% of the globe's capital markets, you have less overlap, but it's still a consideration. And there's lots of funds out there that do exclude Canadian investments, and that's something to consider because, again, most Canadians just on their own will have exposure to, especially the banks. So you don't, again, want to double up on twice as much Canadian exposure as you probably want. So just distinguish between global, that's the world, international, which is the world minus your own specific country. Diversification, we talked about that. That dovetails with the multitude of investment options out there. And diversification, as we've covered, is probably the critical issue for investors. All investors, but especially for smaller investors. And in fact, it's that diversification that is probably the make or break factor in the true success of portfolio growth over time. Now, one of the areas that a mutual fund is good for is that you may lack the critical mass to achieve diversification. If you have a $100,000 portfolio or a $50,000 portfolio, we had talked previously about if you're good, maybe 25 to 30 stocks will give you diversification, and then maybe another 15 or 20 bonds, and then some cash. You spread yourselves pretty thin if you try to go out and buy those individually. Whereas if we look at a lot of mutual funds, a Canadian mutual fund may have 200 stocks in it. An American might have 500, for example, the S&P 500. Or a global fund may have 300, 400 stocks. Diversification that you probably can't get on your own. You also may lack capital for certain investments. We discussed shares of Google or even Amazon, these ones that are trading in the 4-figure range. If you're trying to put away $300 a month to invest in individual equities, how do you buy those? Much more cost effective to go and buy the S&P 500, which has in relatively high portions the Apples, the Amazons, the Microsoft, the Teslas, the Facebooks. So just more effective to create diversification through these things. Mutual funds are also quite painless to purchase. The harder they would be to purchase, the less likely you are to use that specific fund company. So they want to try to make it as easy as possible to invest. And you remember that you buy or sell through the fund company itself. And I'll put a little caveat in there because often you can buy through your own investment account at your bank, but it's still going directly to and fro with the fund company. You're not trading it on an exchange. You can usually set up direct deposits, dividend reinvestment plans, link it to your tax deferred accounts. Again, everything is painless. Instead of trying to track 60 investments on an Excel spreadsheet every month, you have your performance, your NAVs calculated daily, your performance calculated maybe monthly, maybe daily. Easy to track. Fund companies, they'll send you your tax documents so you know, okay, this is how much dividend or interest income. These were my capital gains that float out. Very easy. Liquidity, also relatively easy. And I say relatively just because there is some nuances or some issues on smaller funds, but for the most part, there's no need for you to find a counterparty. If I own a stock of a less liquid junior oil company, I need to find somebody to buy that investment off my hands. And as we discussed with liquidity, there's that time value relationship. The faster that I need to sell the asset, the lower the cost I might have to take to execute the transaction. Whereas the longer the time period I can wait, the closer I'll probably get to fair market value. But here you're just buying and selling with the fund company itself. And unless they go bankrupt, which granted is a possibility, then you can trade usually on a daily basis based on the net asset value at the close of business. The other thing that's easy is the net asset value, the NAV, is transparent. So you can easily see what the value of your assets are worth because you're buying or selling based on that NAV. So from a liquidity side, again, unless you're dealing with a small or a distressed fund company, and I would recommend that you stick with the big established firms, then liquidity is probably quite easy with those companies. Low cost, maybe I'll put an asterisk on that statement, but that is a perceived advantage. Mutual funds, yeah, cost effective, in large part because diversification on your own can be costly. We just talked about having to go out and buy 30 stocks. Now there's the transaction costs. That's a hard cost. If I can go out and buy one mutual fund, and let's say it's no load, so it's free, versus even if I'm paying $10 per transaction, if I'm going out every month and trying to buy 30 different stocks to add to my portfolio, then that's $300 in transaction costs every month. And over time, that adds up. And yes, you'll probably use different strategies where if you've got 30 stocks in your portfolio, then this month, maybe I only buy 5. So every 6 months, you end up buying through the cycle. But it still adds up. As we talked earlier, the pooled resources avoid spreading you too thin. So that's a cost saving. Not something to worry too much about, but there are economies of scale on some purchases, especially fixed assets. So the more that you can invest, the better the interest rate that you might get, for example. So that's also a cost saving. By pooling the money with others, you might get better interest rates on fixed income. And we talked previously about the opportunity cost. If you're a doctor, a lawyer, a dentist, a teacher, a nurse, etc., you work a hard day on your own job. Do you really have the time or energy to come home and look at investments? Now, some people enjoy that, but for most of us, it's the family, it's the social life, it's the sports, it's the leisure. Don't want to be sitting there tracking 30 different companies every month or every week or however often you want to do it. And the final perceived advantage of mutual funds, at least the actively managed funds, which we differentiate from index funds, is they're professionally managed. And again, that goes back to, do you want to spend your evenings analyzing investments and deciding what to keep and what to sell and what new to buy? Or do you want to hand that over to a investment quote unquote expert? So in theory, professional investment management should be a big positive. You have professional investors. This is their expertise. This is what they do for a living. They manage your money. And I will say the investments are all well researched. Portfolios are monitored. They're updated as needed. So that is a big advantage. The issue is that it comes at a cost, the management fees. And that sort of gets at what we'll look at probably in a week or two, is the active versus passive management debate. Do professional managers, do active portfolio managers bring alpha? And that is, do they bring a positive return on the portfolio versus their benchmarks? So do they beat the passive index fund through their active management? And the answer tends to be no, for a variety of reasons. So that's sort of something, yeah, in theory it makes sense that a professional managing your portfolio should be the way to go. In practice, less so. But it is a perceived advantage at times. That's all I want to cover. A nice short section just sort of wraps up a lot of the advantages we've already discussed. Next session, we'll look at some of the disadvantages or perceived disadvantages of investing in mutual funds. Thank you for your time. Have yourself a good day.